Hi, I'm Mark Beveridge from the Quill Group Investment Committee, here to just give you a quick update on coronavirus, markets and what we might expect going forward. Mark Twain said, "History doesn't repeat itself, but it often rhymes." And in the context of coronavirus, we can have a bit of a look at the past and analyse how that impacted markets previously and what might happen in the future. The world certainly experienced epidemic cases before. We've had Ebola virus, SARS, MERS, and having a look at the reaction to those crises can give us an idea of what impact we might see from this COVID 2019, as it's officially called. Some of the questions that you might have is, what's the impact of coronavirus on the stock market? What's the impact on my portfolio? And are there any opportunities in the wake of this coronavirus? At the time we've written this, the death toll from coronavirus was 1,115 people, with about 45,000 infected across 28 countries. Obviously the majority of those are in China. In terms of rhyming with history, I think it's agreed that nothing has topped the Spanish flu for death rates. There was 50 million people killed by Spanish flu in 1918 and 1919. And we're grateful to Nick Maggiulli, who's a data scientist at Ritholtz Wealth Management in the US, for the charts on these pages. And we've also added a link there, and it's in the notes to the show as well, so you can go and get his full story, which includes not only these Spanish flu comparisons, but also the SARS and MERS numbers. In red, what he plots here, so when the chart is red, it's got death rates increasing, and when the chart's gone green, it means the rate of deaths per thousand is actually gone into decline, so the crisis is passing. There was a little bit of a lump there as well. In this chart, he uses the same colour coding. Ironically, while the death rate was rising, which is indicated by the red line there, the market was also still rising at that point in time. It was actually only after the death rate peaked that market started to go into decline, and actually declined about 10% following that, and then stayed fairly flat for a couple of months after that. But then within a few months of that, they went on to rise again, and were up about 15% in just those few months. Now certainly the world was less connected then versus now, so the rates of infection could spread more quickly, but in that case the reaction from markets was quite muted. In terms of impact directly on the markets from this current outbreak, we've got a few charts here where we show with the black arrow there the date that the Chinese health authorities first announced the first fatality from this COVID 2019. And the first chart we've got here is the Shanghai Composite Index. It was starting to fall as soon as that first death was announced, and continued to decline through to January the 23rd there, when authorities announced that the market was going to remain closed until February the 3rd. Now when they reopened on February the 3rd, obviously the market gapped down and opened quite a bit lower at 2,716, which was off 12.8% from that high point back there. However, since that day, as you can see, the market has actually risen every single day for 7 days straight now, and it's only 6.8% down from that peak point back there. Copper is often referred to as Dr. Copper in market circles. It's also a good indicator of the general economic environment. And here we see that after making constructive gains through to December, indicating a few green shoots in the economy, it then took a hiding as the coronavirus risk became apparent. And that peak to trough fall there was about 11.5%. But Dr. Copper too is now showing some signs of stabilising since the end of January, and starting to pick up a little bit. Australia, well, we're a country that's got the most exposure export-wise of any country to China, and basically we've shrugged off the whole episode. At worst, we barely touched the levels where we were when that first death from coronavirus was announced, and it seems like the flood of money from superannuation and the powerful forces of low interest rates have been a very strong support for the Australian market. And in fact, in the little chart over on this side, I've got the average growth fund since the 1st of January, and as you can see, it's up about 3.25% since the 1st of January. So with everything that we know, it certainly hasn't had any impact so far on portfolios to any extent at all, really, and it's been quite a strong period. Are there any opportunities? We know that there's always opportunities in crises, and one that jumps to mind is the makers of face masks and sanitising products, which is Reckitt Benckiser Group. It's a UK company, and it actually owns the Dettol brand. So it was the first one that sprang to mind. It's not a recommendation, but it is a reminder that professional investors can take advantage of these situations, and as you can see, the stock's up 6.9% since that first death from COVID-ID. I'm reminded of what Lord Rothschild's once opined. He said, it's best to buy on the cannons and sell on the trumpets. In other words, to buy when it's becoming apparent that there is a problem, and not actually to be a seller at that point in time. So make no mistake, there's certainly still risks to the economy. It's not likely that death rates are the biggest risk though, as much as it is obviously tragic for those affected. The bigger risk economically is from changes in consumer behaviour. If the crisis was to extend and the quarantines bring supply chains to a halt. But certainly central banks have been very supportive, and that's been pumping liquidity into the markets. And that was what was apparent from that chart that we showed of the Shanghai Composite Index. So we think that the current strong liquidity and the low forward returns that are available in bond markets means that it's likely that money keeps flooding into shares for the time being. And it's also worth thinking about the normal annual expected volatility that exists in the share market. The median intra-year decline is about 11.5%. And in fact, it's quite rare that we don't get at least a 10% plus decline at some point during the year. Some of these years where we only got a 3% decline or a 5% decline were the exception rather than the rule. So if a 10% decline at some point during the year is normal, then we need to accept that and embrace it as a necessary part of investing for the long term. So thanks for watching our update. If you have any questions, your Quill Group advisor is more than happy to provide you with any additional research that you might require.